Jeff, if we take a look at the Fed and its role in the overall market and us being 1% away from record highs, is the Fed that catalyst that gets us to top that record from last summer?
I don't think so. I think what we'll hear from Powell is that this is still not part of an extended series of rate cuts, but merely some insurance measures in response to some of the weakening in manufacturing, a few other areas. So I'm not sure the market's going to get the all clear from the Fed that it's looking for. Instead, I think the more important central bank meeting this month was the European Central Bank. We've seen European bank stocks rally pretty powerfully ahead of that news and through that news. You know, the last time we saw a big move from the ECB like this, they continued to rally, could have more to go.
All right, so if the European banks are a good signal, are there other parts of the U.S. banking system that could be kind of validating that particular feel in global markets?
It's hard to see. You know, in the U.S., lower interest rates are going to weigh on bank profitability. In Europe, they've now tiered those lower interest rates to where they're not going to have that negative drag on the banking system. And the QE they're implementing in Europe is a boost to their balance sheet. So insulating their income statement from lower interest rates and yet boosting their balance sheet from QE. That's not happening in the U.S., where it's just lower interest rates, which in fact act as a drag.
There is a justification right now in global markets that the U.S. stock market deserves to be at record highs and deserves to keep trending higher because the economy here is doing better than so many other places around the world. Is that the case, and can we expect that economic strength relativity to continue?
U.S. economic strength is better than it is elsewhere in the world, but that's not really the key to what drives corporate earnings. Remember, the stocks that make up the S&P 500 get their earnings from around the world. They have the same geographic sales distribution as companies headquartered in Europe or Asia. It's not really about the U.S. economy solely. And the big picture tells me that as we look at the larger picture, things are slowing broadly. The U.S. is far more focused from a sector perspective on technology. And if, in fact, this rotation we're starting to see away from growth sectors towards value holds, and in the past, over the last 50 years, we've seen rotations from one style to another around yield curve inversion. So that says to me this could have some legs. That may suggest a rotation away from U.S. dominance.
All right, so I'm an oil consumer. I fill up my tank. I'm a commuter in my car every day. I drive to work. Does that mean that low gasoline prices are better for the overall economy? Or is the job growth from higher CapEx spending in the energy patch enough to kind of outweigh that? What's more important?
You know, that's a great question. We just don't know yet. In the U.S., obviously, the energy sector has become much more important in terms of jobs and in terms of S&P 500 earnings, for sure, relative to the overall economy and the impact on the consumer. I think the consumer, being in the position they are right now, strong confidence, good income growth going into the fourth quarter, with oil prices now up basically within the range they've been over the last 1 year, not breaking out to new highs, I think we'll be okay here from a consumer perspective. And the higher oil prices won't be the catalyst that throws us into the next recession.